Welcome back, friends. The US Federal Reserve is the $7 trillion gorilla in the financial markets, and investors are willing to bet that it will keep throwing its weight around as and when needed. It has done in the past, and there are every signs it will do again. However, the last week was a little different. US Central Bank showed little hesitation in wading into the market during the panic in March 2020, and investors took comfort from knowing that the Fed and its chairman Jay Powell had their back. But this week they were rather frustrated by the reluctance of Jay Powell to indicate or to show any way that the Federal Reserve is going to expand its balance sheet once again, which is one of the important triggers that stock markets need from time to time. Equities sold off sharply during Mr. Powell's press conference and did not regain much momentum thereafter, which raises questions that are the global stock markets living on steroids? Although the Fed pledged that it would not raise interest rates until inflation had outstripped its 2% target, which is likely to be many years away from here, no new guidance came on how it might adapt its balance sheet policy to generate that inflation and aid the US economic recovery. That was something that the market was hoping to get more clarity, and the US Federal Reserve Chair Jay Powell failed to deliver it in so many words, I may say so. The March turbulence prompted the Fed to begin a program of unlimited asset purchases and to set up 11 lending facilities to shore up a broad swath of hard-hit debt markets. What resulted was an unprecedented expansion of its balance sheet. Between March and early June, it ballooned from roughly $4 trillion to a peak of just over $7 trillion, but since then its growth has stalled. The Fed's bond buying program currently involves purchasing $80 billion of Treasury securities per month and $40 billion of agency mortgage-backed securities. Having decided last month to pursue a new monetary framework in which it allows inflation to run above its 2% target, that's the change in the policy last month, expectations were of course elevated for a rethink of that strategy, friends. While the Fed did reframe the purpose of its purchases from strictly an issue of market functioning to one tied to supporting the economic recovery, Jay Powell did not signal an imminent adjustment either in the scope or scale of its program. Some believe that it is necessary for the Fed to shift the focus of its purchases specifically to long-dated treasuries in order to ensure that the borrowing costs remain low, while others feel that a larger program was warranted. There was an inconsistency with the super strong forward guidance on rates and quantitative easing, which was slightly more loosely defined, I would say. So the Fed's current approach to bond buying could be termed as weak, and it is not sure whether they will deploy all its instruments. Jay Powell faced questions about what many had hoped would be an important pillar of its coronavirus response so far, the Main Street Lending Program, or what is popularly known as the MSLP. This is one of the 11 lending facilities rolled out since March under powers that allow the central bank to make asset purchases in unusual and exigent circumstances. It differs from the sorts of programs that it ran in previous crises because it involves purchasing loans made by banks to small and medium-sized businesses, hence the Main Street name. Again, I repeat, it's called Main Street Lending Program, or MSLP. While the usage has remained modest across all the Fed's facilities, a phenomenon that investors largely attribute to the fact that to the robust rebound in financial markets, the failure of the $600 billion MSLP to gain traction has provoked concern because it suggests that the smaller companies that are the backbone of the US economy are not benefiting as much as the large ones from the reopening of capital markets. Just $93.8 billion of the Fed's balance sheet firepower is being deployed through the various emergency measures. That is down from a high of $107 billion in July and is less than 4% of the minimum $2.6 trillion. $2.6 trillion. I repeat, that the central bank has said it would make available. For the MSLP, only $1.4 billion has been lent so far, or 0.2% of its total capacity. For smaller companies, survival is something which is a matter of great concern, not only in terms of potential bankruptcies, but also in terms of the delinquencies that can happen as we go forward from here. I believe that the stage is, however, being set. Yes, the Federal Reserve and Jay Powell will be back very soon. My take is that whatever we felt was missing in Jay Powell's comments in his press conference last week, he will be back with more firepower. Greater expansion of Fed's balance sheet is definitely around the corner. The seeds have been sown. There is turbulence returning in the financial markets, and the financial markets are running out of steroids. It is time for the Federal Reserve, and I believe very soon you will see Jay Powell return with another dose of steroids. Happy investing and take care. Bye-bye.